I'm sitting here looking at Berkshire Hathaway's balance sheet, and I need to tell you something that's making me deeply uncomfortable. We're holding $344 billion in cash and short-term treasury bills as of June 2025. That's not a typo. $344 billion doing essentially nothing but collecting a modest yield. For context, that's more cash than the entire GDP of countries like Finland or Chile. And if you know anything about how I've run Berkshire for the past 6 decades, you know I hate holding cash. I've always said that cash is trash in an inflationary environment, that it's a terrible long-term asset. So why am I sitting on a cash pile that represents 28% of Berkshire's entire market value? Let me be direct with you. I'm scared, not panicked, not irrational, but genuinely concerned about what I'm seeing in the American economy right now. I've been investing since 1951, and I've lived through 13 recessions, multiple market crashes, stagflation in the 70s, the dot-com bubble, the 2008 financial crisis, and the COVID pandemic. I've seen economic cycles that would make your head spin. But what's happening right now has a different character to it, a different texture that reminds me of the warning signs we ignored before 2008, except this time the scale is exponentially larger. Here's what particularly concerns me. In the second quarter of 2024 alone, I sold $75.5 billion worth of stocks. That's not normal portfolio rebalancing. I dumped nearly half of our Apple position, selling 389 million shares when Apple was trading near all-time highs. Apple has been our largest holding, a company I've called one of the greatest businesses in the world. I also sold significant portions of Bank of America, reducing our stake from over 1 billion shares to around 766 million shares by October 2024. These weren't small trims. These were massive liquidations. Now, some people on Wall Street are saying I'm just taking profits, that I'm worried about capital gains taxes going up. Sure, that's part of the calculation. But I've been managing money for 70 years, and I don't make $75 billion decisions based solely on tax policy. The real reason is much simpler and much more troubling. I cannot find anything worth buying at current prices that offers an adequate margin of safety. When I look at the S&P 500 trading at a Shiller PE ratio of 34.8 as of October 2024, I see valuations that are only exceeded by 2 periods in American history, right before the 1929 crash and during the dot-com bubble in 2000. Both of those episodes ended catastrophically. The market capitalization to GDP ratio, which I've called the best single measure of valuation, hit 195% in September 2024. That's nearly double its historical average of 100%. I've always operated on a simple principle: be fearful when others are greedy and greedy when others are fearful. Right now, I'm seeing greed everywhere I look. Retail investors are piling into stocks at rates we haven't seen since the meme stock craze. Options trading volume hit record levels with 44 million contracts traded daily in October 2024. Zero-day options, which are essentially pure gambling instruments, now represent 45% of all S&P 500 options volume. So yes, I'm holding cash, lots of it, because when you can't find good pitches to swing at, the best strategy is to wait patiently with your bat on your shoulder. But the cash position is just a symptom. The real disease is what's happening with America's balance sheet, and it's far worse than most people realize. On November 1st, 2024, the U.S. national debt officially crossed $36 trillion. Think about that number for a moment. In the year 2000, our national debt was $5.6 trillion. In just 24 years, we've added $30.4 trillion in debt. That's an increase of 543%. During that same period, our GDP only grew from $10.2 trillion to $28.70 trillion, a 181% increase. We're borrowing money at triple the rate we're growing our economy. Here's what keeps me up at night. In fiscal year 2024, the United States government paid $1.13 trillion just in interest on our debt. Let me put that in perspective for you. Our defense budget for 2024 was $842 billion. We're now spending more money on interest payments than we are on our entire military. And that military budget includes everything from aircraft carriers to nuclear weapons to salaries for 1.3 million active duty service members. Interest expense is now the second largest line item in the federal budget, behind only Social Security. I've seen the projections from the Congressional Budget Office, and they're terrifying. By 2034, they estimate we'll be paying $1.7 trillion annually in interest. But here's the thing, those projections assume interest rates stay relatively stable, around 3.5% to 4%. The 10-year Treasury yield was sitting at 4.43% on November 6, 2024. If rates stay elevated or go higher, those interest projections become laughably optimistic. Let me explain the mathematical trap we've built for ourselves. When interest rates were near zero from 2008 to 2021, we could borrow massive amounts of money cheaply. The average interest rate on our debt in 2020 was just 1.6%. Politicians from both parties went on a spending spree because debt service was essentially free. But now, as the Treasury refinances maturing debt, they're rolling over bonds that paid 1% or 2% into new bonds, paying 4% or 5%. The average maturity of U.S. debt is only about 6 years, which means roughly 17% of our total debt needs to be refinanced every single year. Do the math with me. We have $36 trillion in debt. If we're refinancing $6 trillion per year at current rates around 4.5%, that's $270 billion in new annual interest expense just from refinancing every single year. And we're still running annual deficits of $1.8 trillion in fiscal 2024, which means we're adding new debt on top of the old debt we're refinancing. This creates what I call a debt doom loop. Higher interest payments increase the deficit. A larger deficit requires more borrowing. More borrowing means more Treasury bonds flooding the market. More supply without proportional demand pushes yields higher. Higher yields make the interest payments even more expensive. And the cycle continues, feeding on itself like a cancer. I've studied sovereign debt crises throughout history: Argentina, Greece, Japan in the 90s. They all followed similar patterns. The difference is that when Greece collapsed, the world didn't end, because the drachma wasn't the global reserve currency. When America's debt becomes unsustainable, there's no IMF big enough to bail us out. We are the financial system. The Congressional Budget Office projects our debt to GDP ratio will hit 166% by 2054. But I think that's optimistic because it assumes we'll somehow develop the political will to slow spending. Nothing in our current political environment suggests that's remotely possible. Now let me tell you what's happening in corporate America, because this is where the rubber meets the road for everyday investors. I've been watching the balance sheets of America's largest companies deteriorate in ways that remind me of 2007, right before everything fell apart. Total corporate debt in the United States hit $10.5 trillion in the third quarter of 2024. That's up from $6.3 trillion in 2015. Companies have added $4.2 trillion in debt in less than a decade. Here's what concerns me most. During those years of essentially free money from 2010 to 2021, corporations didn't use that cheap debt to invest in productive capacity or research and development. They used it for financial engineering. American companies spent over $5.1 trillion on stock buybacks between 2015 and 2023. They borrowed money at 2% or 3% to buy back their own shares, artificially inflating earnings per share and pumping up executive compensation tied to stock prices. I've called this behavior economic suicide in slow motion. Let me give you a concrete example. AT&T was carrying $169 billion in total debt as of the second quarter of 2024. That's more debt than the annual GDP of Hungary. Their interest expense in 2023 was $6.2 billion, eating up nearly 40% of their operating income. They're spending almost as much money servicing their debt as they are investing in their 5G network infrastructure. Boeing, another industrial giant I've watched for decades, had $52.3 billion in debt as of September 2024 with negative free cash flow. They're burning cash while carrying debt loads that would have been unthinkable 20 years ago. The commercial real estate sector is even worse. I've been in the insurance business through Berkshire for 40 years, and I can smell a disaster brewing. Office buildings across America are sitting at 19.6% vacancy rates as of October 2024, the highest since 1991. But here's the really ugly part. $929 billion in commercial real estate loans are coming due between now and the end of 2025. These loans were underwritten when buildings were 95% occupied and interest rates were 3%. Now those same buildings are 80% occupied and refinancing rates are 7% or higher. I've seen the data from the Fed. Banks are sitting on $558 billion in commercial real estate loans, with regional banks holding the lion's share. New York Community Bancorp nearly collapsed in February 2024 after revealing massive losses in their commercial real estate portfolio. Their stock dropped 37% in a single day. That was a warning shot that nobody seems to be taking seriously. Here's what happens next, and I've seen this movie before. Companies that borrowed heavily at low rates now face a refinancing wall. In 2025 alone, $788 billion in corporate bonds are maturing. Investment-grade companies will probably be able to refinance, though at much higher rates that will crush their profit margins. But high-yield companies, the ones rated BB or below, are going to face a bloodbath. Default rates for high-yield bonds were already climbing to 2.8% by October 2024, up from 1.1% in 2022. I'm watching the interest coverage ratio for the S&P 500, which measures how many times companies can cover their interest payments with operating income. It's dropped from 9.2 times in 2021 to 6.4 times in the third quarter of 2024. That's a 30% decline in just 3 years. When that ratio drops below 4, bankruptcies start accelerating rapidly. We're heading in that direction at alarming speed. Let me take you inside the banking system, because what I'm seeing there is perhaps the most dangerous part of this entire puzzle. I've been in the banking and insurance business my entire career, and I can tell you that American banks are sitting on a ticking time bomb that most depositors have no idea exists. As of the third quarter of 2024, U.S. banks were holding $650 billion in unrealized losses on their securities portfolios. That's not a projection or an estimate. That's the actual number reported to the Federal Reserve. Here's how this happened. From 2008 to 2021, banks loaded up on treasury bonds and mortgage-backed securities, yielding 1% to 2% because that's all that was available. Those bonds were considered safe, liquid assets that satisfied regulatory requirements. But when the Fed raised rates from 0.25% in March 2022 to 5.5% by July 2023, those bonds lost enormous value. A 10-year Treasury bond yielding 1.5% is worth roughly 25% less when new 10-year Treasuries are yielding 4.5%. Banks don't have to recognize these losses on their income statements as long as they hold the bonds to maturity and classify them as held-to-maturity securities. But make no mistake, those losses are real. Silicon Valley Bank collapsed in March 2023 with $16 billion in unrealized losses on a $117 billion securities portfolio. They got caught in a classic duration mismatch, short-term deposits funding long-term assets. When depositors started withdrawing money, SVB had to sell those underwater bonds at massive losses to raise cash. Within 48 hours, they were insolvent. First Republic Bank failed 2 months later with similar problems. Signature Bank went down the same week as SVB. Now, I'm watching regional banks very carefully because they're the most vulnerable. They hold $2.9 trillion in commercial real estate loans, representing 28% of their total loan portfolios. I mentioned earlier that office vacancy rates are at 19.6%, but in major cities like San Francisco, it's 36.7%, and in Houston, it's 27.4%. Those empty buildings can't generate the rent revenue needed to service their mortgages. Here's what particularly worries me. Banks use something called the extend and pretend strategy. When a commercial real estate loan comes due and the borrower can't refinance at current rates, the bank extends the loan maturity rather than forcing a sale and recognizing the loss. This keeps the loan classified as performing on the bank's books, even though everyone knows the building is worth far less than the loan amount. The Fed reported in October 2024 that banks had modified or extended $143 billion in commercial real estate loans over the previous 12 months. That's code for we're hiding the losses. I've studied bank failures going back to the Great Depression. The pattern is always the same. First, you get a handful of failures at smaller institutions. Regulators say the system is sound, that these are isolated incidents. Then you get a cascade as depositors at similar banks get nervous and start moving money to larger institutions they perceive as safer. The bank runs spread faster than regulators can respond. In 1933, we had 4,000 banks fail. In 2008, we had 465 banks fail over 5 years. The FDIC's Deposit Insurance Fund had $129 billion as of September 2024. That sounds like a lot until you realize there are $18.6 trillion in total deposits in the U.S. banking system. The insurance fund covers 0.69% of deposits. If we see even a modest wave of bank failures, that fund gets depleted instantly, and we're right back to taxpayer bailouts. Now let's talk about the American consumer, because this is where economic theory meets kitchen table reality. I've always believed that consumer spending is the engine of our economy. It represents 68% of GDP. But what I'm seeing right now isn't healthy spending driven by rising wages and confidence. It's desperate spending fueled by debt, and the numbers are absolutely staggering. American households are now carrying $17.5 trillion in total debt as of October 2024. Let me break that down for you. Mortgage debt stands at $12.52 trillion. Auto loans at $1.63 trillion. Student loans at $1.6 trillion. And credit card debt just hit an all-time record of $1.13 trillion in the third quarter of 2024. That credit card number should terrify you. Credit card debt has increased by $247 billion since the first quarter of 2022. That's a 28% increase in less than 3 years. And it's not because people are living lavishly. Real wages, adjusted for inflation, are still below where they were in 2019. The average American worker earned $1.118 per week in the third quarter of 2024, which sounds decent until you adjust for inflation and realize that buys less than $1,067 worth of goods compared to 2019 purchasing power. Here's what's killing people. The average credit card interest rate hit 22.8% in October 2024. That's the highest rate since the Federal Reserve started tracking this data in 1994. If you're carrying the average credit card balance of $6,501 and making minimum payments, you'll pay $13,000 in interest alone over the life of that debt. People are borrowing money at 22.8% while their savings accounts pay maybe 4.5%. That's a financial death spiral. I've been watching the delinquency rates and they're flashing red. Credit card delinquencies, accounts more than 90 days past due, hit 3.2% in the third quarter of 2024. That's up from 1.9% in early 2022. Auto loan delinquencies climbed to 2.9%, the highest since 2010. These aren't just statistics. These are families who can't make their car payments, who are choosing between groceries and credit card bills. The personal savings rate tells an even grimmer story. Americans saved 4.1% of their disposable income in September 2024. During the pandemic in 2020, that rate spiked to 16.3% because people couldn't spend money and were receiving stimulus checks. Now we're back below the historical average of 5.5%, and heading lower. People are draining their savings to maintain their lifestyle. The total amount in savings accounts dropped by $1.4 trillion from April 2022 to September 2024. Here's what concerns me about sustainability. The average monthly car payment is now $739 for new vehicles as of October 2024. The average new car price is $48,623. And people are financing these purchases over 72 or even 84 months at interest rates between 7% and 9%. I'm seeing people commit to paying $900 a month for 7 years on a depreciating asset. That's insane financial behavior, but it's becoming normalized. Mortgage payments aren't any better. The median home price hit $420,400 in September 2024, while the average 30-year mortgage rate was 6.72%. That means the typical monthly payment on a median-priced home with 20% down is $2,186, not including property taxes and insurance. You need an annual household income of roughly $105,000 to afford that comfortably. The median household income in America is $74,580. The math simply doesn't work for millions of families. Let me tell you about something that most people don't pay attention to but absolutely should: the Treasury market. This is the foundation of the entire global financial system, and it's showing cracks that genuinely frighten me. The U.S. Treasury market is the largest and most liquid bond market in the world, with over $27 trillion in outstanding securities as of October 2024. Every interest rate in the global economy, your mortgage, your car loan, corporate bonds, everything is priced off Treasury yields. When this market stops functioning properly, the entire financial system seizes up. Here's what's happening that nobody's talking about. Foreign holders of U.S. Treasury securities have been net sellers for the past year, dumping $220 billion in treasuries throughout 2024. China, which was once our largest foreign creditor, has reduced its holdings from $1.3 trillion in 2013 to just $774 billion as of August 2024. Japan, our largest foreign creditor, cut its holdings from $1.15 trillion to $1.12 trillion over the same period. These aren't small adjustments. These are massive portfolio reallocations away from U.S. debt. Why does this matter? Because we're running deficits of $1.8 trillion annually, which means the Treasury Department needs to sell roughly $150 billion in new bonds every single month just to fund the government, plus refinance maturing debt. When traditional buyers like China and Japan step back, someone else has to step in. Right now, that someone is primarily domestic buyers, banks, pension funds, and mutual funds, but they're demanding higher yields to compensate for the risk. I've been watching the 10-year Treasury yield very carefully. It hit 4.70% on October 23, 2024, the highest level since July. For context, that yield was 0.93% in August 2020. We've seen a 377 basis point increase in just 4 years. Every percentage point increase in borrowing costs adds roughly $360 billion to our annual interest expense once the entire debt stock rolls over. The mathematics are brutal and unforgiving. Here's what really concerns me about market structure. In September 2024, we saw several Treasury auctions that were poorly received, with bid-to-cover ratios falling below normal levels. A 20-year bond auction on October 16th had a bid-to-cover ratio of just 2.34, meaning there were only $2.34 of bids for every dollar of bonds offered. That's weak demand. When the market doesn't fully absorb new supply, yields have to rise to attract buyers, which makes our debt more expensive. The Federal Reserve's balance sheet adds another layer of complexity. During the pandemic, the Fed bought $4.6 trillion in Treasury securities and mortgage-backed securities to suppress interest rates. Now they're doing quantitative tightening, letting roughly $60 billion per month roll off their balance sheet without replacement. That's $60 billion in bonds that need to find new buyers in the private market every single month at the same time the Treasury is issuing new debt. I've lived through the 1970s when 10-year Treasury yields hit 15.8% in September 1981. I remember what high borrowing costs did to the economy: 3 recessions in 11 years, unemployment over 10%, entire industries wiped out. The difference is that our debt to GDP ratio in 1981 was 31%. Today it's 123%. We cannot afford 1980s interest rates with 2024 debt levels. If 10-year yields hit even 7%, we're talking about $2.5 trillion in annual interest expense within 5 years. That's 1/3 of all federal tax revenue going just to pay interest on money we've already spent. For decades, I've told investors that a diversified portfolio of 60% stocks and 40% bonds would protect them through almost any market environment. Stocks provide growth during good times, bonds provide safety during bad times, and historically, they moved in opposite directions. When stocks fell, bonds rallied, cushioning your portfolio. That conventional wisdom died in 22, and I don't think it's coming back. In 2022, the S&P 500 dropped 18.1%, while the Bloomberg U.S. Aggregate Bond Index, the core bond benchmark, fell 13%. Both assets collapsed simultaneously for only the third time since 1926. A traditional 60/40 portfolio lost approximately 16%, one of the worst years on record for that strategy. Here's why this changes everything. The negative correlation between stocks and bonds existed because of a specific macroeconomic regime: low inflation and falling interest rates from 1981 to 2021. During those 4 decades, whenever the economy weakened and stocks fell, the Fed would cut interest rates, which pushed bond prices higher. It was a beautiful, predictable pattern that made portfolio construction relatively simple. But that regime is over. We're now in a world of persistent inflation, high government debt, and structurally higher interest rates. I've been studying the correlation between stock and bond returns, and what I'm seeing is alarming. The 60-day rolling correlation between the S&P 500 and 10-year Treasury bonds turned positive in 2022 and has remained elevated through 2024, fluctuating between 0.3 and 0.6. In plain English, stocks and bonds are now moving in the same direction roughly 60% of the time. When inflation spikes or the Fed signals higher rates, both stocks and bonds sell off together. Your bonds aren't protecting you anymore. They're adding to your losses. Let me explain the mechanics of why bonds have become so dangerous. A 10-year Treasury bond has a duration of approximately 9.2 years, which means for every 1% increase in yield, the bond loses roughly 9.2% of its value. If you bought 10-year Treasuries in August 2020, when yields were 0.93%, and you still hold them today with yields at 4.43%, you've lost approximately 32% of your principal value. That's not a safe asset. That's a catastrophic loss that would take decades to recover through interest payments alone. Gold, the traditional safe haven, isn't behaving normally either. Gold hit $2,790 per ounce on October 31st, 2024, up 35% for the year. Normally, gold rallies when real interest rates are negative, but we currently have real rates around 2% after adjusting for inflation. Gold is rising despite positive real yields because central banks are buying aggressively. They purchased 800 tons in the first 3 quarters of 2024, and because investors are losing faith in paper currencies, when gold rallies in an environment of high real rates, it's telling you something is fundamentally broken in the monetary system. Real estate, another traditional hedge, is facing its own crisis. The Case-Shiller Home Price Index showed home prices up 4.2% year over year as of August 2024, but that's decelerating rapidly from the 20% gains we saw in 2021. With mortgage rates around 6.7% and prices still elevated, housing affordability is at the worst level since 1984. The monthly payment on a median-priced home consumes 43% of median household income. Historically, that ratio stays around 25%. Real estate isn't a safe haven when prices are this disconnected from incomes. Cash generates negative real returns after inflation. Stocks are overvalued at historically extreme levels. Bonds are vulnerable to further rate increases. Gold is unpredictable and produces no income. Real estate is unaffordable. I'm looking at the traditional asset allocation playbook, and nearly every page has been torn out. Let me tell you about the 3 specific triggers that could ignite this powder keg, because understanding the catalyst is just as important as understanding the vulnerabilities. I've been through enough market crises to know that the timing is impossible to predict, but the trigger points become visible months or even years before they detonate. Right now, I'm watching 3 mechanisms very closely, and any one of them could set off a cascade that spirals out of control. The first trigger is the Japanese yen carry trade, and this is more dangerous than most people realize. Here's how it works. For decades, Japanese interest rates have been near zero or negative, while U.S. rates were higher. Hedge funds and banks would borrow yen at 0.1%, convert it to dollars, and invest in U.S. assets yielding 4% or 5%. The difference is pure profit, as long as the yen stays weak against the dollar. The total size of this carry trade is estimated at $4 trillion globally as of 2024. But on July 31, 2024, the Bank of Japan raised rates for the first time in 17 years from 0.1% to 0.25%. The yen immediately strengthened from 161 per dollar to 142 within 2 weeks. That triggered a massive unwinding. Traders had to sell their dollar assets to buy yen and repay their loans. The Nikkei stock index crashed 12.4% on August 5th, the worst single-day drop since 1987. The S&P 500 fell 3% that same day. That was just a warning tremor from a small rate increase. If the Bank of Japan raises rates to 1% or higher, which they've signaled they may do, we could see $1 trillion in forced selling of U.S. stocks and bonds as carry trades unwind globally. The second trigger is a wave of commercial real estate defaults that overwhelms the banking system. I mentioned earlier that $929 billion in commercial real estate loans mature by the end of 2025. Here's the breaking point. If delinquency rates on those loans hit 8% to 10%, which is entirely possible given current vacancy rates and refinancing costs, you're looking at $75 billion to $93 billion in losses. Regional banks have razor-thin capital buffers. The average Tier 1 capital ratio for regional banks is around 10%, meaning they have $10 in capital for every $100 in assets. A $75 billion loss would wipe out the capital of multiple regional banks simultaneously. The FDIC can't handle a multi-bank failure scenario. We saw that in March 2023 when 3 banks failed in 1 week and nearly triggered a systemic panic. If 10 or 15 regional banks become insolvent in a short time frame, we're talking about deposit freezes, bank runs, and a complete loss of confidence in the financial system. The third trigger, and the one that frightens me most, is a failed Treasury auction. The Treasury sells roughly $150 billion in bonds every month. What happens if one day there aren't enough buyers at reasonable yields? In October 2024, we saw weak demand at multiple auctions with bid-to-cover ratios dropping below historical averages. If a major auction fails, meaning the Treasury can't sell all the bonds it needs to sell without spiking yields dramatically, that sends a signal to global markets that U.S. debt is no longer considered safe. Yields could jump 50 to 100 basis points in a single day. That repricing would instantly devalue every Treasury bond on bank balance sheets, triggering the unrealized loss problem I discussed earlier. It would also make our deficit immediately more expensive to finance, creating a doom loop of rising yields and rising deficits. So what am I doing about all of this? Let me walk you through my exact positioning and the specific steps I believe every American should be considering right now. First, that $325 billion in cash I'm holding at Berkshire isn't sitting idle, earning nothing. It's invested in short-term Treasury bills yielding between 4.5% and 5.2%. I'm staying on the very short end of the curve with maturities of 3 months to 1 year. This gives me 2 advantages. I'm earning a decent real return after inflation, and I have maximum flexibility to deploy capital when opportunities appear. When assets go on sale during a crisis, and they will, I'll have dry powder ready while everyone else is scrambling for liquidity. Second, I've dramatically reduced my exposure to the banking sector. I sold more than half of our Bank of America position throughout 2024, even though I've been on their board and have called Brian Moynihan one of the best bank CEOs in America. This isn't about Bank of America specifically. It's about the entire sector's exposure to commercial real estate, unrealized bond losses, and the likelihood of a credit cycle turning ugly. I'm keeping our position in American Express because it's fundamentally a payments company with a wealthy customer base, not a traditional bank with a balance sheet full of long-duration assets. Third, I'm focused on businesses with pricing power, low capital intensity, and strong free cash flow. I've been adding to our positions in companies like Coca-Cola and Chevron, businesses that own irreplaceable assets and can pass inflation through to customers. Coca-Cola raised prices 11% in 2023 and barely lost any volume. That's real pricing power. Chevron owns oil reserves that become more valuable as energy prices rise with inflation. These aren't growth stocks trading at 40 times earnings. These are cash-generating machines trading at reasonable valuations between 12 and 18 times earnings. Now, let me tell you what you should be doing, because not everyone has $325 billion to invest. First, build a cash buffer of at least 6 months of expenses, preferably 12 months. Keep this money in Treasury bills or high-yield savings accounts, currently paying 4.5% to 5%. Yes, you'll pay taxes on that interest, but you'll have liquidity when you need it. During the 2008 crisis, people who had cash reserves didn't have to sell their stocks at the bottom or default on their mortgages. Second, if you own bonds or bond funds, look at the duration. If you're holding long-term bond funds with durations above 7 years, you're taking enormous interest rate risk for very little additional yield. The difference between a 2-year Treasury at 4.25% and a 10-year Treasury at 4.43% is only 18 basis points as of November 2024. That tiny extra yield isn't worth the 800% increase in duration risk. Move to shorter maturities. Third, reduce your debt aggressively, especially high-interest credit card debt at 22.8%. There is no investment on earth that reliably returns 22.8% after taxes. Paying off that debt is the best guaranteed return you'll ever get. If you're carrying $10,000 in credit card debt, eliminating it saves you $2,280 per year in interest. That's equivalent to earning $2,850 in a taxable investment account, assuming a 20% tax rate. Fourth, avoid the temptation to chase yield in risky assets. I'm seeing people pile into junk bonds yielding 8% or dividend stocks with 7% yields from over-leveraged companies. When the credit cycle turns, those high yields disappear as defaults spike and dividends get cut. A 7% yield means nothing if the principal value drops 40%. The window for preparation is closing fast. Make your moves now while markets are still functioning normally.